Hello and welcome to another episode in the Prosperity Thrive Drive channel, where we thrive boldly and we prosper fully. My name is Charity Mwangi, your host, and today we are going to talk about the different lenders. In the previous episode, we've talked about the interest rate calculations and we've talked about the different loans that different lenders offer. So today we are going to talk about three of the lenders that we mentioned. We'll talk about the banks, we'll talk about the SACCOs, and we'll talk about the Microfinance Institutions. So welcome and stay tuned. So today in this episode, we'll talk about how these institutions lend, how they grow their money, and how you can be able to tell the institution that is aligned to your financial goals. So let's briefly define these three lending institutions. To start with, the banks. So banks are licensed financial institutions that provide an array of services. They provide loans, they give savings options, they offer forex services, they offer investment services, and also some banks are involved in insurance. They have subsidiaries that offer insurance services. So banks in every country are regulated by the central bank of that specific country. So banks, for example, in Kenya are normally regulated by the Central Bank of Kenya. The next one are the SACCOs, Savings and Credit Cooperative Societies. And these are member-owned institutions where individuals come together and pool their funds. They save together so that they can be able to access loans, because loans in SACCOs are given based on the amount that you have saved. And also, in addition, for SACCOs, they are member-owned. So it's the members who are shareholders of the SACCO. Microfinance institutions are similar to banks, and they focus on small and medium enterprises and individuals, but they are also regulated by the central bank. Some of the microfinance institutions that we have in Kenya are like Faulu, Kenya Women Finance Trust, Rafiki, and there are so many others that are there in the market. So let's start with the banks. For bank services, for example, the loans, they give a wide range of different types of loans. They have personal loans, salary loans, mortgages, development loans, business loans, agriculture-based loans, construction loans. They will give credit cards, they will give overdrafts and all that. They have a very wide range of loan products. So the interest rates for most bank loans is calculated on amortization. We discussed about amortization model of interest. So most loans that you'll find in banks are offered on amortization basis. So when you apply a loan in a bank, the approval process can be long depending on the loan that you're applying for, because banks apply very high due diligence and KYC, know your customer. So they're very thorough with their due diligence before they grant you a loan. The other process that is involved is that banks will always check your status, your credit history with the CRB. You might have a good history with the bank, but probably in other lending institutions, your credit history is wanting. So they'll always check your credit score status through the CRBs. So again, on loans, based on the loan that you're taking, there are requirements that are needed. There is a security for the loan, or whether they request for logbook or a title deed. And if it's a salary loan, they'll request for your pay slips for a certain number of months. Of course, your identification. And if you're in business, they'll require the business records, probably audited accounts for the last 3 years or 2 years or 1 year, depending with the bank. So that's why also as a business person, it's very important to keep your records accurate, to ensure that all your financial records are audited and there's an audit report. So let's talk about SACCOs in terms of loans. SACCOs also have a wide range of loan products, from development, what they call personal loans, normal loans, emergency loans, salary loans, some offer overdrafts, and there are so many loans that different SACCO offer. Regarding the interest rate of SACCOs, you'll find that most of their loan products will be calculated on reducing balance, and the interest rate for SACCOs most of the time will be lower than other lending institutions. The unique thing about the SACCOs is that you borrow based on what you have saved, what is on your deposits account. So some SACCOs will give 3 times, 2 times, 4 times, even 5 times, depending also on the loan that you're taking. So the loans that are granted by most SACCOs are based on what you have saved in the deposits account. But of course, when they do the multiplication, they also require you to provide collateral, either in form of guarantors who should be members of the SACCO, or title deed, or a logbook, or any other security that that particular SACCO accepts as per their policy. So on loan requirements, some SACCOs may require you to provide payslips. They may require you to provide bank statements if you're in business. They may require you to provide your business permits, your business records, that's the audited accounts for your business. So it depends with the loan policy of the SACCO and the requirements for a particular loan. So let's talk about the microfinance institutions that target the small and medium businesses. They are also very famous with chama loans. They lend organized groups, that's what we call chamas, based on different criteria that they may use, based on maybe their the chama savings, based on maybe the number of members that are there in the chama, or they might also look at the purpose of the loan that the group is getting. They'll also definitely require security for the loans, probably in the form of logbooks, title deeds, and any other security that is aligned to their credit policy. So how do these institutions grow your money? Let's start with the banks. So the banks will offer different investment products. Some will have fixed deposit products. Some also offer savings products that have a return at the end of the period. Others also trade in money market funds. So it's good to check what your bank is offering. For the SACCOs, there is the dividends that is paid on the share capital at the end of the year. There is the interest on deposits that is paid on your deposit at the end of the year. There is also savings products that some SACCOs offer, and some SACCOs also offer fixed deposit savings products. So for the MFIs, you'll find them offering fixed deposit products or savings products. So in terms of regulations of these institutions, the banks are regulated by the central bank. The SACCOs are regulated by SASRA, that's the SACCO Societies Regulatory Authority. And the MFIs are also regulated by the central bank. So it's very important, especially if you're in a SACCO, to check if your SACCO is regulated by SASRA, because this reduces your risk of loss of your deposits, because SASRA is able to oversee and check the financials of the SACCO and the processes that are run in that SACCO. So at the end of the day, there is no perfect institutions. Even the banks that are regulated by the central bank might be mismanaged, the SACCOs as well, the MFIs as well. So it's very important to be up to speed with what is happening with your financial institution, whether it's the bank or the SACCO or the MFI. So thank you for joining in on this episode. Please subscribe and like and comment, and see you in our next one.